This video is going to discuss our range bar indicator. It is used for the purpose of trading high probability scalps. It's very easy to use, very easy to see, and very, very high probability. Range bars show up on this 100 ES tick bar as a yellow bar. A range bar is simply any bar that is at least 2 ticks in size. So for example, these bars right in here are only 1 tick, whereas this bar is 2 ticks. The significance of these bars become evident when the following occurs. If a range bar either opens or closes at the high or the low of the bar, it becomes especially significant. If it closes in between the high and the low, it's of no significance at all. But if it closes at the high or the low, it becomes significant. So for example, right here, these 2 bars, the range bar closed at the low, but the next bar split the difference. It moved up to at least the midpoint of the bar. Now when that occurs, the value of the range bar no longer exists. Similarly, this range bar, it closed at the high, but the very next bar moved down to split the difference between the high and the low. So in and of itself, it gave us no opportunity to trade. The opportunity exists when the range bar either closes at the high or the low, and the market never splits the difference, or at least not immediately. When that occurs, the probability is very, very good that it will eventually turn and split that difference at least. And that's where the trading opportunity comes in. So let me show you an example of this. All right, so now here we have an example right here of a range bar where the subsequent bars do not come back down and split that difference. In fact, they continue to move up some 3 ticks before they start to move back down and finally split the difference. There you have your trading opportunity. It's a scalp, okay? It's a scalp. So what you're going to try to do, and we've just used a very fast stochastic here to show you an opportunity to get in. You're going to short that market, and you've got a couple of ticks profit before it splits that difference. It's just that simple. Now here's another example right here. On this bar, market moved down a couple of ticks and starts to move up. This isn't a real good trading opportunity, but it illustrates the point nevertheless. When the very next bar or the bar thereafter does not come back up, you have enough time to respond if you're paying attention. There are instances where there is a significant opportunity to trade. Let's take a look at a few of them. Here on the same day, we have another opportunity. We have a range bar. Market continued to move up 3 ticks. You look for the opportunity to short that, move it down 3 ticks for it to split the difference. Now here's another opportunity. This bar right in here. Now this is right before the open, and you have to be very careful about range bars that are forming prior to the open or right after the close. They do not have the same probability, but this illustrates the point we have a range bar, market moved down, came back up, split that difference. So in this case, 4 ticks, a 1-point move. Now here was a spectacular opportunity for the range bar. All right, here's the range bar, and I've drawn a horizontal line here. Now, I'll grant you that if you used a fast stochastic for this particular instance, you're going to get stopped out a lot. There are other ways to examine the move of the market so that you don't find yourself in this situation. But the point of the matter is the market moved considerably beyond the range bar, this taking place at a little after 9 o'clock, and that range bar does not wind up getting filled, if you will, until close to 11:30. So you have to be cautious about this. But it is nonetheless a very high probability trade. Here's another good example. Range bar moves up 1, 2, 3, 4, ultimately 5 ticks. Get a nice 4-tick move back down before that range bar gets filled. And by fill, I mean a subsequent bar will come down and split that difference. It's very high probability. And last but not least, again, here's this range bar here. Market moved up 3 ticks, comes back down, splits that difference. Okay, it happens every day, and sometimes several times a day. So if all you did was just wait for range bars to form, use a good indicator to base your entry off of, you've got a very high probability of success. I would say in a given day's time, way better than 90%. I've never really gone about calculating it, but I'm fairly confident that it's higher than 90%. A true scalper's dream. It just works. You just have to be careful. You just have to wait. But it will eventually form. And when it does, it's great. Now, our indicator allows you to keep track of other range bars that happen with far less frequency. This indicator here is set to a two-tick spread. You can go higher, 3 ticks. Okay, but that is a very rare item using a 100-tick bar of the ES. Going to a 200-tick bar, you're liable to see it with a little bit more frequency, but even then, during the normal day's activity, it does not occur. And when it does, it's usually over and done with fairly quickly. And here we have one example of the range bar using a 3-tick approach. And when we use a 3-tick range bar, well, whoops, I just lost it. A 3-tick range bar will generally move 2 ticks. In other words, this 3-tick, it should move down 2 ticks. And that's what it does. But again, it can happen fairly quickly. And it doesn't happen very often. But that's how we use range bars for our scalper's dream at the present time. Works very, very well. So that concludes this video.